My name is Jake, welcome to the channel. In today's video, we're going to talk about should you invest in SVOL as a dividend investor. Now, this is a high income ETF. If I had a nickel for every time I saw someone here on YouTube pump this ETF, this SVOL ETF, I have a lot of nickels. I keep getting comments on my videos about this ETF. For example, hello Jake, putting it out there. Have you ever considered having a position in SVOL? High expense ratio, but the monthly dividend yield makes up for some of the downside. I bought into the fund with a small amount for fun, very unlike me, done well with index funds, and very adverse to risk. And I've been seeing comments like this for months on this ETF on my videos. I've gotten even a few emails regarding this ETF, and I'm just like, okay, fine. I'll make a video on this. It's not something that I really want to make a video on, but obviously a lot of you are talking about this and you want my opinion. And so sure, I'll make a video on it. I've been creating dividend investing videos on YouTube for over 5 years. And in those 5 years, there's one thing for certain that I've noticed among the dividend investing community, and that is we as a community here on YouTube, we suffer from a serious case of groupthink. I've seen time and time again these new flashy income ETFs pop up, and all of a sudden people believe they are the next best thing since sliced bread. Lucky for you watching my videos, I don't subscribe to the idea of groupthink. I share what I actually think. It may be an unpopular opinion compared to what you've seen other content creators here on YouTube create, and you may disagree with what I have to say, but I hope you're willing to at least watch and listen with an open mind. I want to start by saying that everything in this video is just merely my opinion and based on the research that I've done that's publicly available on the ETF's website and what I can find online. Whenever I consider recommending a stock or an ETF, I always ask myself the question, would I be comfortable recommending this stock or ETF to my family? And in the case of SVOL, I would absolutely not recommend this to my family. In this video, I'm going to review SVOL. I'm going to share how the distributions are taxed, what I like about it, what I don't like about it, and who should consider investing in an ETF like SVOL. My goal with this video is to hopefully give you an objective overview of the fund and give you the facts so that you can make your own decisions. I'm not trying to tell you what to think, but rather how to think. What you do with this information is entirely up to you. What you don't want to do is blindly invest into an ETF like SVOL because somebody on YouTube or wherever is pumping this ETF and not really understand what you're investing in because it might end up not going to plan and it could look a little like this.
Oh my God, Stevie, no!
I could end the video and that would explain everything that you need to know about investing into this ETF. Oh my gosh. All right, so the ETF is from Simplify. It's a new company. So Simplify was founded in 2020 to make institutional grade alternative strategies available to all investors through the low cost and transparent ETF vehicle. Now, the thing that I like about this ETF or this approach of what they're trying to do is they're making, products, investment products available to retail investors like you and I, which were unavailable to you and I, the regular investor, prior to 2020. So I guess you could say they're, in a weird way, democratizing, if you want to look at it from a Robinhood perspective, democratizing, different investment strategies that were once unavailable to the common person. Okay, but the fact that they put low cost, I think, is a slap in the face because this is by no means a low cost ETF. Jack Bogle would be turning in his grave if he could see what they're charging. Because this is an actively managed fund, you have to understand that what you're investing in the people behind this fund. So if you're serious about investing in this ETF, I would take a look at their leadership team. If you really want to trust these people with your hard-earned money, make sure that you understand that this is an active fund. It is not a passive fund. Okay, so it's very dependent upon the decision making and of course what the market's going to do, obviously, but very much dependent on the decision making of this active management style of investing. Okay, so it's very important that you understand that. All right, now I want to give you a brief overview of what this ETF is, what is the objective of this ETF, and what could you reasonably assume if you were to invest into an ETF like this. So according to their website, everything that I'm pulling here is from their fact sheet, from their prospectus, and so it's not my opinion. I'm just reading off of their disclosures, their information on their site. The Simplify Volatility Premium ETF, SVOL, it seeks to provide investment results before fees and expenses that correspond to the approximately 1/5 to 3/10 the inverse of the performance of the SVOL Volatility Index, or the VIX Short-Term Future Index, while also seeking to mitigate extreme volatility. How many retail investors on YouTube know what the heck that even is? I bet you probably, half of the people that invest into this ETF don't even know what the VIX is, or truly understand what they're investing in. So SVOL aims to provide an attractive income stream and source of diversification while seeking to avoid risks inherent to other income-producing asset classes. This downside risk protection, it gives me a lot of vibes of Nusi. Remember that old girlfriend that we no longer talk about? Yeah, that's kind of what it reminds me of. The old ETF that shall not be named again. The fund's short VIX position, and if you know. If you didn't understand what I just said, it's okay. Welcome to YouTube and Dividend ETFs on YouTube. Nusi, go look it up. The fund's short VIX position provides investors an optimized exposure for monetizing the premium in the VIX futures market. A modest option overlay budget is then deployed into VIX call options to help protect against adverse moves in the VIX. So this is the exact opposite of investing into an actual business like Coca-Cola. You're investing into S&P 500 VIX futures. You're not investing into a business. Okay, do you understand that? And so the title of this video is, should dividend investors invest into this ETF? Should a dividend investor invest into this? Okay, so that's important that you keep in mind the context of who I'm talking to. I'm talking to dividend investors, and you're not, when you invest in this SVOL, it's clearly, you're not investing into a business, you're investing into an options or a derivative strategy of the VIX future market. So their key points here: the first ETF providing inverse VIX exposure coupled with dynamic hedge. Great. Okay. 25% of the fund is short the VIX. So they're not shorting everything with all of their assets, or the NAV is not all going towards shorting the VIX. Okay, they have deep out of the money VIX call options, which seek to provide low cost protection against extreme VIX spikes. They should just, yeah, okay. They got monthly distributions, no schedule K1. I do like the no schedule K1. That is nice. The monthly distributions, what retail investor does not want monthly distributions, right? Okay, why you would invest in this ETF is for income as well as asset class diversification. Okay, asset class. So if you're just investing into SHD and DGRO, you're only investing into one asset class. And so the purpose here is to get more diversification to other areas, different asset classes. And so those are the two utilities of this index, or reasons why you would invest into this ETF. And I'll look at the holdings here in a second on a different slide. But one thing that's important that you understand is the fine print. So this ETF, the use of leverage by the fund, such as borrowing money to purchase securities or the use of options, will cause the fund to incur additional expenses and magnify the fund's gains or losses. That doesn't sound good. That doesn't sound like what a dividend investor wants. Magnifying losses, or sounds like if you want magnifying gains or losses, you should go invest in a Tesla. Or something else. It doesn't seem like a conservative dividend investor would want that, but let's keep reading. VIX future contracts can be highly volatile, and the fund may experience sudden and large losses when buying, selling, or holding such instruments. VIX futures are unlike traditional futures contracts, not based on a tradable asset, and it is possible to lose a portion or all of an investment. Well, wait a second. It's possible that I can lose all of my investment? Right here, a portion or all of your investment. Isn't that a disclaimer? Invest into this ETF, but we do trade on leverage, and you possibly may lose all of your investment. Okay, that sounds great. What? Well, if you're still watching the video after realizing that, let's keep going. So this right here is from their prospectus. This is kind of repeated what they showed in their fact sheet. It just kind of, this is kind of the legal jargon of the fund may do this, or it may do that, or it is designed to do this. Remember, this is an actively managed fund, so the fund managers have discretion of how they go about, you know, operating the fund. And if you're a longtime, you know, buyer or shareholder of this fund, you'll notice that they've actually changed their strategy up quite a bit here fairly recently. So the fund does change. It is actively managed. The options overlay is a strategic persistent exposure meant to hedge against market moves and to add convexity to the fund. If the market goes up, the fund's returns may outperform the market because the advisor will sell or exercise the call option. If the market goes down, the fund's returns may fall less than the market because the advisor will sell or exercise the put option. So it's a derivative strategy. The fund anticipates purchasing and selling options on a monthly, quarterly, and annual basis, depending upon the fund's rebalancing requirements and the individual option expiration dates. Okay, so what's also really, really important to understand, this is a leveraged fund, an inverse leveraged fund, and so it resets daily. And that's why in the disclosure that in a catastrophic event, that's how your investment can go to zero, is it resets on a daily basis. It's like the reason why I don't invest into the TQQQ, the triple leveraged, NASDAQ ETF, is because the risk is unlimited. The upside is great. The downside is also great. And the downside is unlimited, right? So because it resets daily. And so you have to understand that what you're actually investing in. All right, so moving on here, let's see here. So you got the risks, the future risks, the daily rebalancing risk. This is the really important thing here, borrowing risk. The fund may, this is the legal thing, they may, I wonder how much they actually do, borrow for investment purposes indirectly using reverse repurchase agreements. The cost of borrowing may reduce the fund's return. Borrowing may cause the fund to liquidate positions under adverse market conditions to satisfy its repayment obligations. Borrowing increases the risk of loss and may increase the volatility of the fund. But wait, I thought that this was like a low volatility option. They have that all over their, their website. They market it as a low volatility. Well, it's low volatility until it's not low volatility, as we all learn in those black swan events. So lastly here, leverage risk. The use of leverage by the fund, such as borrowing money to purchase securities or to use the use of options, will cause the fund to incur additional expenses and magnify the fund's gains or losses. So this is a leveraged ETF. It is a leveraged fund, and you as the investor have to understand that. All right, let's take a look at their site here, and let's look at a few pieces of information. It's a whopping 1.16%. It's like 3-4 times that of JEPI or JEPQ. So this is by no stretch of the imagination a low cost fund, but relative to what else is on the market, similar or comparable, it's astronomically higher than what you can get with, for example, a JEPI or a JEPQ. But yeah, anyways, let's take a look at it. So yeah, so management fees, very, very high, by no means low cost. Let's take a look at, we'll look at the performance here in a second. But what I want to take a look at next is their portfolio holdings. And I do believe that the holding strategy, or they now hold treasuries and bonds. And is my understanding, don't quote me on this, but is my understanding that this was not the case maybe a year ago. And so they've changed up the top holdings quite a bit. And so the top, like what, 30 or 40% or so are in other ETFs, I believe, that they also own, and they're high, bond ETFs, right? Like, so you can go and buy BND and get other bond ETFs, but they put in their own ETFs in this. So it's kind of like a double bubble. Yeah, you have treasuries in here, you have aggregate bonds, and yeah, so this is like a hybrid or I'm going to use a really weird way of phrasing this. This is like a Frankenstein ETF. Oh my gosh. This is a Frankenstein ETF, at least like what you can look in here. It's like okay, let's put this in there. Let's put this in here. And let's like, oh my gosh. Okay. Frankenstein. They should have made that the ticker instead of SVOL, Franken or something like that. Frankenstein. So you got a Franken. It's almost Halloween. Frankenstein ETF here. You got, yeah. So it's kind of got like a hybrid strategy of bonds, treasuries, and their option strategy, their overlay strategy, as we just read in here. And you can see their puts in here. Yeah. Okay. So it's not like a traditional ETF where you got Johnson & Johnson, Merck, you know, AbbVie, Coca-Cola, Broadcom. This is not an ETF that holds businesses that are producing anything. Okay, so really, really important. All right, now let's jump over here to Seeking Alpha really quick and let's take a look at some of the dividend metrics. What? It's got like a 16% dividend yield? What dividend investor wouldn't want that? Oh my gosh, 16%. Okay. All right, so it is a fairly new fund. So the dividend yield here, when was its inception? Back in middle of 2021. So it had at one point at one time 18%. This is based off of the distributions, forward trailing distributions at the current price. And yeah, you can see that it's gone down a little bit because the distributions have gone down, which we'll get to in a second. The growth, you know, you can't even really look at the growth because the fund has been around for such a short period of time. It's gone down, but this can be very deceiving. They can artificially make it look like the distributions are growing by just returning capital to you, so through return of capital, which we'll get to in a second. This is not uncommon. This is very common with these other income ETFs that you'll see here that are popular on YouTube. Looking at the dividend history, you can see they pay a monthly dividend. Ironically, they pay the same dividend. How do they pay the exact same dividend every single month, where before they didn't? So they changed their strategy before, back in 2022, 2023. They've obviously changed up their strategy, and so it's a little bit different. But the reason why they're able to maintain this dividend, and I'll get to this in a second, is through return of capital. Okay, they're returning your initial investment back to you. That is how they're able to maintain this. All right, so let's take a look at the performance. Now, what we're gonna do is we're gonna look at the total return. Okay, so we're gonna do that. In order to do that, we're gonna incorporate with the dividend. So the total return is the share price and the dividends. That comprises the total return that you're seeing. And when you look at the total return, you just compare that to the S&P 500, it's done fairly well compared to the S&P 500. Now, if we go and we look at, when did it come out? Middle of 2021. Let's do July 5th. I don't know, July 5th. And let's compare the total return of SVOL versus the S&P 500. It's actually outperformed the S&P 500. So everything that I'm saying, I'm being very critical. I'm being obviously very critical in this video. If you've watched the video this far, I've been very critical of this ETF for good reason. But at the end of the day, returns are all that matter. Okay. And so if they're able to maintain a total return that is outpacing the S&P 500, you don't have to listen to me. The returns speak for themselves. And I want to be objective and fair by saying that. Okay. The returns mean much more than just some random guy's opinion on the internet. Okay. So I do want to highlight that. All right. So the performance has done well, but the thing that I want you to be aware of is, where is this return coming from? And are they going to be able to maintain this going forward? And in order to do that, what we're going to look at is I'm going to use a tool called Portfolio Visualizer. And I'm going to look at, well, what is the difference between the yield, the dividend income, and the actual share price? And how do they compare? And, you know, versus, for example, let me show you this. For example, I'm going to compare SVOL versus JEPQ. Now, this is not entirely, to make it apples to apples. I don't want anybody in the comments saying, oh, that's not apples to apples. Well, let me make it apples to apples. JEPQ is tracking the NASDAQ, and the fund managers on their website, they always compare it to the S&P 500. S&P 500 is the benchmark for comparing. So I will add in JEPI in here because I don't want to entirely cherry pick the example here, okay? Because I call out other people when people cherry pick, and I don't want to cherry pick as much here. So, all right, so we're going to take a look at these three, JEPI, JEPQ, and SVOL. And you'll notice here that it only goes from January 2023. So this is not really representative. Take this with a big grain of salt. But you can see the total return of SVOL since then has been, annually has been 19%. JEPQ has been 31%. And JEPE, which tracks the S&P 500, has been 11%. JEPE has not been performing very, very well. It's been kind of like a bond. It's not done so amazingly well. So what I want to show you here is what the return would be without the dividend. So if we break up what the return has been with the dividend, you'll notice here that before it was 19%, all of the return is coming from the income. Okay, which is not crazy. I mean, it's an income-focused ETF, the way the strategy is set up. So you wouldn't expect much capital appreciation from this ETF, right? And you can clearly see that the return is purely coming from the income that the fund is through the active management of this fund. That's how they're producing the income. But if you compare that with like a JEPQ, you're still getting a sizable amount of the return through the capital appreciation. By using JEPQ as an example, I'm showing you that it's possible that you can get both. You can get high income and you can get capital appreciation. And you look at that here with JEPE, also seeing that you're going to get low capital appreciation with JEPE, right? So I'm showing you these three examples. And so I invested in a JEPQ for exactly this reason. I'm getting capital appreciation and I'm getting a very, very high distribution yield through the income that JEPQ produces also on a monthly basis at a fraction of the cost. Okay, so I'm just showing you that to help you understand, where the returns are coming from and to give you an example of, comparing it to JEPQ and JEPE. Next, I want to talk about how SVOL is taxed. Okay, this is probably one of the most important things when it comes to these ETFs. This is always the elephant in the room when it comes to these ETFs. Is it return of capital? Is it not return of capital? How is the dividend being taxed? Okay, so this is next to the total performance and everything and the NAV erosion, all that good stuff, this is like the most important thing for an income investor is understanding how your distributions are taxed. Now, I probably have said dividend in this video. It's just by habit. It's actually a distribution. Okay, so I want to make sure if I said dividend and you're like, oh, why is Jake saying dividend? Because it's not a dividend. It's just out of habit. Okay, I usually talk about dividend ETFs. Okay, so just to throw that out there. So this is the distribution history since the fund's inception. And you'll notice here, let me go up here. So you got the ordinary income, you got short-term capital gains, long-term capital gains, which you're really not going to have with an ETF like this because they're, focused on treasuries and they're not holding actual businesses, right? So it's unlikely that you'll have short-term or long-term capital gains. And you'll notice the total distribution here for July was 30 cents per share. And the breakup of that was 26 cents of the 30, or almost 90%, was return of capital. Okay, and you look at that here, you're like, well, okay, well, that's the large percentage is return of capital, but it's not always been like that. If you go back since, last year in 2023, a year ago, it was zero return of capital. It was all ordinary income, okay, which is taxed at, your W-2 rate, your non-qualified rate, right? And so up until recently, it was always ordinary income. And let me go a little bit slower. I'm going a little fast. Up until recently, you can see here, since the fund's inception, it was always ordinary income. There was no return of capital. And then I mentioned, I believed that they changed their strategy with the fund. And it's likely once they changed the strategy, the holdings in the fund, that it changed. But you'll notice here, if you've been an investor in this ETF for years, the way you're taxed is entirely different today than it was when you first started investing in it. Now, this could be a pro or con depending on who you are. So I want to be fair when I say that. And in doing my research, I researched on their website and they made some videos. And while watching one of their videos here, this video is 5 months old. And when it talks about the return of capital. In this video, when I was watching this, I was like, wait a second, this doesn't make any sense. In the video, it says the majority of the distributions will typically be classified as income. Well, I don't know what your definition of typically is, but my definition of typically or maybe is not 90% of the distribution. Okay. And every single month since, September 2023, the overwhelming majority in most cases, has been return of capital. So I think you guys need to update your videos here and your marketing on your website, because 90% is not a little bit of a return of capital. That's a lot of return of capital. But yeah, it just goes to show you can't just watch something and just assume that it's true. So they can be very deceptive in terms of their phrasing and wording. Maybe or typically, that's just your legal jargon for BS, in my opinion. All right, now what I want to do is I want to talk about what I like about SVOL, and then I want to talk about what I don't like about SVOL, and then, I'll wrap up the video by sharing who should consider an ETF like this. So what I like about SVOL is...
Brother, what's that? What's that, brother?
All right, what I don't like about SVOL is, anything positive about this ETF, I just want to mention, is that you can find in other ETFs for a fraction of the expense. What I don't like about this ETF is they're targeting vulnerable retail investors. SVOL would not exist if there wasn't a market of retail investors who were willing to invest into it. Okay, so I don't like the fact that there, in many cases, many vulnerable retail investors who don't actually know what it means to short the VIX futures market is. Like, I would bet that two-thirds of the people investing in this ETF don't even truly know what it does. So that's why I believe that they're targeting vulnerable retail investors, and I don't like that. And once again, I don't have any proof for that. Obviously, that is just merely my opinion. The next thing that I don't like about this is, I've been on YouTube for 5 years creating content around dividend investing, and I've been investing for about 17 years. I have a marketing background, I have a sales background, and I understand the power of buzzwords. Okay. And there's a lot of buzzwords with this company. They use buzzwords that people think are a good thing, right? Downside protection, volatility protection. If you're an uninformed retail investor and you see downside protection, volatility protection, you automatically assume that that's a good thing without even reading between the lines and really understanding what you're getting there. Or overhyping high income, or monthly distributions. You type in monthly distribution, volatility protection, and every retail investor who wants income is gonna, they're gonna just open the floodgates and everyone's gonna want in, right? Because who doesn't want that? Who doesn't want a high monthly distribution with downside protection? There's just so many buzzwords, and it just turns me off when I see that. The next thing that I don't like about this ETF is the fund methodology and the strategy as a whole. I don't think that most dividend investors should look to diversify their portfolio by shorting the VIX futures market. And that's why the title of this video is, should dividend investors invest into this? I don't like the fund methodology. I think it's ridiculous. Just because, something exists and is available, it doesn't mean that you really need it or you should buy it. That's just how I view it. Another thing that I don't like about this ETF that I've talked about before is the high expense ratio. It's highway robbery. I think they should charge a fraction, like they could cut the expense ratio in half and it would still be fairly high. It'd be a little bit more reasonable, but the expense ratio is too high for what they're offering. And, I can't tell for sure, but it kind of, like when I look at other charts, it looks like they have NAV destruction, but I can't tell for sure. But this is something that I would definitely have on my radar if I was interested in this ETF is this return of capital going to be destructive return of capital? And that would be something that I would put on your radar. I can't say for certain, but that was something that I would definitely take a look at and be mindful of. And then lastly here, who should consider investing into SVOL? So the only people, so like I said, I don't think anybody should invest in this ETF, but if you're hell-bent on, you want this ETF and you're gun-ho on it, you really, really like it, someone who should consider this is you explicitly want to have exposure to an actively managed fund that tries to generate high income or high monthly distributions with a short exposure to the S&P 500 VIX short-term futures. If you absolutely want to short the VIX and generate income from shorting the VIX futures market, which is reset daily and is on leverage and has the potential to go to zero, be my guest. Okay, you can invest in it. Another reason why you may want to have exposure to this ETF is you want exposure to treasuries or bond ETFs, but bear in mind at a very high expense ratio. Another reason why you maybe want to have this is you want to have additional diversification, different asset classes. We talked about that, which in this case, I would refer this to, diversification, in my opinion. Example could be, if you have 100% invested into stocks, equities, and you absolutely want to add diversification by shorting the VIX, you want to short the VIX as a dividend investor. When you say that out loud, say that out loud with a straight face. I'm a dividend investor and I want to short the VIX. Go to town. If that's what you want to do, then you should consider investing in this ETF. So I guess some of my final thoughts are that just because something is available to buy, there's a product for sale, it doesn't mean that you should buy it. There's so many other options out there that I think you could probably just play eeny, meeny, miny, mo and just randomly select anything else and you'd probably be better off. Oh my gosh. Once again, guys, my opinion. Don't hate me. This is just my opinion. Even if they lowered their expense ratio to zero, I still wouldn't touch this with a 10-foot pole. The main reason I would never invest in this SVOL or an ETF like this is because it goes against what I as a dividend investor value, and that is investing in a business. A dividend is not magic. A dividend is generated from cash from operations from a business. You can call me old-fashioned and that's okay, but the same reason I don't invest into gold or commodities or anything like that is I want my investment to produce something. And SVOL produces nothing. It appears that the fund managers have changed their approach over the last few years in terms of what they've held into the fund, and I prefer to invest into an ETF that holds a basket of companies that provide real value in the world and actually produce something. The title of this video was, Should you invest in SVOL as a dividend investor? And my answer to that is no. I do not believe real dividend investors should invest in a SVOL for the reasons that I've explained in this video. But that's just my opinion. And, as a live and let live investor, if you do decide to invest in a SVOL, that's cool. We can still be friends. Well, that's my honest review of this ETF. Now you guys can stop commenting in the comments that I should talk about it. I can't imagine I'll be getting any calls from the fund issuer Simplify ETFs to sponsor any of my future videos. If I wouldn't recommend it to my family, I sure in the heck ain't gonna recommend it to you. I hope you got value out of the video and that you learned something, or at least it gave you a new perspective and it helped fight against that nasty groupthink that we have here on YouTube. And yeah, thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.